So Wall Street has been very, very optimistic, but it's important to realize its rally has been relatively concentrated at a small group of stocks in the technology sector. Now, what's interesting about this is there seems to be a tension between the extraordinary upside momentum of this rally versus the fundamentals, particularly corporate valuations like price to earnings, price to sales, price to book values, all of which suggest valuation levels are stretched.
The four most dangerous words in finance are, "it's different this time." And so we don't think that it is in fact different this time when it comes to the degree of concentration within equity markets. Meaning that past peaks in concentration, whether we're looking at in the early 70s with the Nifty 50 or the early 2000s with the tech giants, they typically result in an environment where that concentration eventually reverses and overall market returns are lower because the biggest weights in the market are starting to underperform.
So whether or not the equity rally is sustainable is a really, really big question. On the one hand, you could make a case that it's not sustainable because you look at the valuation levels of equities and they are very, very high. Currently, for example, the S&P 500's market cap is 191% of GDP, which is the highest it's ever been in history. Also, if you look at ratios like price to sales, which is basically price to corporate revenue, or price to book value, they're also trading at record levels. On the other hand, the Federal Reserve is cutting interest rates, despite the fact that inflation is running above target. All of this could continue to fuel the rally. And you have to remember that just because the market is perhaps overvalued, doesn't mean it can't continue to go higher.
One of the greatest debates right now is, what is the first cut? The Fed cut in 2024 and cut rates 3 times and delivered 100 basis points of cuts. Now we've started again in 2025 with rate cuts, so was 2024 the first cut or is now the first cut? Of course, we've seen strong market performance since that 2024 cut, and it all depends on context of where we go from here. If the Fed is cutting because they can, meaning inflation has moderated and they want to stabilize the labor market, but it's not too weak, then markets can do well. But if the Fed is cutting because it should, meaning labor markets are in free fall, they're doing much worse than what was expected, then we don't think that equities would perform well in that environment. Because if they're cutting because they should, it likely means that very fulsome earnings estimates for 2026 are too high. So it's always good to remember, equity markets like strong growth, risk assets like strong growth. So as long as earnings estimates are moving higher, GDP estimates are moving higher, then what the Fed does is just icing on top. But if you start moving estimates lower, that's where Fed cuts may not be as beneficial to markets.
Well, history so far after the first Fed rate cut seems to be repeating itself, with equities at least initially trending a little bit higher. However, it really depends, I think, on the economic data. If we wind up seeing higher inflation rates later on this year, the market might start to deprice some of the rate cuts it's been expecting for later in 2025 or into 2026. And you could also potentially see alarm on the part of long-term bond investors. And if you wind up with rising yields, especially at the 10 and 30-year points of the yield curve, eventually that could imperil the valuation of some of these technology companies. So I think the single biggest risk in financial markets is that inflation is in fact not under control. This has been kind of the underlying assumption for bond markets as well as for the equity market, that inflation rates have fallen a great deal from their peak in 2022. The problem is that in almost every country in the world outside of Switzerland and China, inflation is running above target and is starting to rise again. And this is potentially very unnerving for investors in long-term government bonds. And if long-term government bond yields begin to rise, that could destabilize the equity market by attracting capital out of equities and back into fixed income.
We have been in an abundant liquidity environment, and that's reflected in things like financial conditions being still easy and very stimulative, despite the fact that the Fed rates are still fairly high. So we think as we go into 2026, it will be really important to watch things like how Treasury is funding itself, what's going on with the Fed's balance sheet, what bond market volatility looks like. because an abundant liquidity environment allows us to trade at high valuations within equity markets. But a tight liquidity environment could see valuations potentially come under more pressure. The big question as we go into 2026 is if we will see the spoils of AI start to spread to more companies. Could we see a productivity boom? We haven't seen a lot of evidence of that yet, but if that is the case, if that starts to materialize, it means that earnings estimates could continue to have more upside, which would be a key driver and key condition for this equity market to continue to rally.